Hi everyone, welcome back to the Investing Iguana, where we talk about all things related to finance and investing. I'm your host, Iggy, and today we're going to explore a topic that has been generating a lot of buzz in the stock market lately: short selling. You may have heard of short selling as a way to make money when a stock price goes down, or as a controversial practice that some people blame for causing market crashes. But what exactly is short selling, how does it work, and what are the risks and rewards involved? In this video, I'll explain everything you need to know about short selling in the US stock market using simple examples and real-life scenarios. So grab your popcorn and buckle up, because we're about to dive into the world of short selling. What is short selling? Short selling is when a trader borrows shares from a broker and immediately sells them with the expectation that the share price will fall shortly after. If it does, the trader can buy the shares back at the lower price, return them to the broker, and keep the difference, minus any loan interest, as profit. Let's say you think that company X is overvalued and its stock price is going to drop soon. You don't own any shares of company X, but you want to profit from its decline. So you go to your broker and ask to borrow 100 shares of company X, which are currently trading at $10 each. Your broker agrees and lends you the shares, but charges you a small fee for the loan. You then sell the 100 shares on the market for $10 each, earning $1,000. Now you have two obligations. You have to return 100 shares of company X to your broker at some point in the future, and you have to pay interest on the loan until you do so. The interest rate may vary depending on the demand and supply of the shares, but let's say it's 5% per year. A few days later, your prediction comes true and company X's stock price drops to $8 per share. You decide to close your short position by buying back 100 shares of company X for $8 each, spending $800. You then return the 100 shares to your broker and pay off the interest on the loan, which is $1 per day for 5 days, $5 total. Your net profit is $1,000 to $800, $5 equals $195. Congratulations! You just made money by short selling company X. Why do people short sell? There are two main reasons why people short sell stocks: speculation and hedging. Speculation is when a trader bets on the direction of a stock price based on their analysis or intuition. They may have various reasons to believe that a stock is overpriced or undervalued, such as fundamental factors, example, earnings, revenue, growth, technical factors, example, trends, patterns, indicators, or market sentiment, example, news, rumors, events. By short selling a stock they think will go down, they can profit from its decline. Hedging is when a trader uses short selling as a way to protect themselves from potential losses due to unexpected market movements. They may already own some shares of a company or an index that they want to keep for the long term, but they are worried that a temporary downturn could hurt their portfolio value. By short selling some shares of the same company or index they own, they can offset some of their losses if the price goes down. For example, let's say you own 1,000 shares of company Y, which are worth $20 each, $20,000 total. You are bullish on company Y's long-term prospects, but you are concerned that a negative earnings report could cause its stock price to drop in the short term. To hedge your position, you decide to short sell 500 shares of company Y for $20 each, $10,000 total. If company Y's stock price drops to $15 per share after the earnings report, your long position will lose $5 per share. $5 times 1,000 equals $5,000, but your short position will gain $5 per share. $5 times 500 equals $2,500. Your net loss will be $5,000 to $2,500 equals $2,500 instead of $5,000. You can then close your short position by buying back 500 shares of company Y for $15 each, $7,500 total, and return them to your broker. Your net profit from short selling will be $10,000 to $7,500 equals $2,500. What are the risks and rewards of short selling? As you can see, short selling can be a powerful tool to make money or hedge your risk in the stock market. However, it also comes with some significant risks and challenges that you need to be aware of before you try it. The first and most obvious risk of short selling is that you can lose a lot of money if the stock price goes up instead of down. Unlike buying a stock, where your maximum loss is limited to the amount you invested, short selling exposes you to unlimited losses if the stock price keeps rising. Remember, you have to buy back the shares at some point to return them to your broker, and the higher the price, the more you have to pay. For example, let's say you short sell 100 shares of Company Z for $10 each, $1,000 total, expecting its price to drop. However, instead of dropping, Company Z's stock price skyrockets to $50 per share due to a positive news announcement. To close your short position, you have to buy back 100 shares of Company Z for $50 each, $5,000 total, and return them to your broker. Your net loss is $5,000 to $1,000 equals $4,000. Ouch! That's a lot of money to lose on a single trade. The second risk of short selling is that you have to pay interest on the loan from your broker. The interest rate may vary depending on the demand and supply of the shares, but it can add up over time and eat into your profits or increase your losses. You also have to pay any dividends or fees that the company pays to its shareholders while you are holding the short position. The third risk of short selling is that you may face a margin call from your broker. A margin call is when your broker requires you to deposit more money or securities into your account to maintain a minimum level of equity. This can happen if the value of your short position increases due to a rise in the stock price or a decrease in the value of your other assets. If you fail to meet the margin call, your broker may liquidate some or all of your positions without your consent. The fourth risk of short selling is that you may be subject to a buy-in or a short squeeze. A buy-in is when your broker forces you to close your short position by buying back the shares at the current market price and returning them to the lender. This can happen if the lender wants their shares back or if there are no more shares available to borrow. A short squeeze is when a large number of short sellers try to cover their positions at the same time due to a sudden increase in the stock price or a positive catalyst. This creates a high demand for the shares and pushes the price even higher, causing more losses for the short sellers. The fifth risk of short selling is that you may face legal or regulatory restrictions or penalties. Short selling is not illegal in the U.S., but it is subject to certain rules and regulations that vary by market and jurisdiction. For example, you may need to disclose your short positions above a certain threshold, borrow the shares before selling them, no naked shorting, or only sell on an uptick, no shorting on a downtick. You may also be liable for damages if you engage in fraudulent or manipulative activities such as spreading false rumors or creating artificial demand or supply. As you can see, short selling is not for the faint-hearted. It requires a lot of research, analysis, discipline, and risk management. It also involves high costs, fees, and taxes that can reduce your returns. However, if done correctly and carefully, it can also offer some attractive rewards such as A. Profiting from declining stocks or markets. B. Zero hedging against downside risk or volatility. C. Exploiting market inefficiencies or anomalies. D. Diversifying your portfolio or strategy. And E. Expressing your views or opinions. So there you have it, everything you need to know about short selling in the U.S. stock market. I hope this video was informative and helpful for you. If you enjoyed it, please hit the like button and subscribe to my channel for more videos like this one. And don't forget to leave a comment below and let me know what you think about short selling. Do you love it or hate it? Have you ever tried it or would you like to try it? What are some of your favorite stocks to short or avoid? I'd love to hear from you. Thank you for watching the Investing Iguana, and I'll see you next time.